it is possible to retire early and pay $0 in taxes over the span of your entire retirement. In this video, I'm going to show you how. We have an early retiree who's retiring at age 50. This person has a joint account with their husband or wife that is worth $500,000. This person also has a traditional IRA that they rolled over from their work. That one is worth $250,000. And then they also have a Roth IRA, which is also worth $250,000. So all in all, this person has a $1 million total portfolio, and they're going to take $40,000 per year to live on starting at age 50. So here we have withdrawals, and these are going to be spent. And finally, we're going to have a column for a seemingly unimportant, but turns out to be very important, standard deduction. So in the first year at age 50, they're going to take out $40,000. So we're also going to have a few assumptions. The first, we're going to assume that this is a zero cost basis, meaning all of this $500,000 is taxable upon sale. You only owe the IRS whatever you sell the stock for compared with what you paid for it. So in this case, if you paid $400,000 for this $500,000 portfolio, you would actually only owe tax on 20% of the account. We're just going to assume, for simplicity's sake, that this is entirely taxable. So anytime you sell out of this account, you're going to have to pay taxes on the gain, unless you earn a total taxable income of just under $90,000 for a married filing jointly person. If you earn less than that, you actually pay 0% tax on long-term capital gains and dividends. Now we're going to pull in this standard deduction. This is the amount that you deduct from your taxes. So let's say you earned $50,000 last year. You're going to subtract $27,700 of that if you are married filing jointly. So in that case, you're only going to pay taxes on, what is that, around $22,000 or so dollars. So what this person's going to do, they're going to withdraw $40,000 from their joint account. That is going to be used to pay their bills. They're also going to take $27,700 out of their traditional IRA, and they're going to convert that into a Roth IRA. If they had no other income, what they're going to report on their taxes is $40,000 in capital gains, which is, of course, going to be taxed at 0%. They're also going to report that they did a Roth conversion, which typically means they would pay taxes on whatever they converted, in this case, $27,700. But since this is all the income they had, the standard deduction is actually going to eliminate that entirely. So they're going to report taxable income of $0, even though they actually took out $40,000 to pay their bills. So how would this look over time? Let's pretend like the market returns 7% per year. Let's assume that inflation averages 3% per year. And let's assume that the IRS tends to increase the standard deduction by 3% per year, which they typically do. So in year number one, they're going to take out $40,000 out of their joint account, and they're going to get 7% total returns in the markets. So the value of this account is going to decline. In the first year, this is going to be left with $492,300. They're going to convert this amount, $27,700, into the Roth IRA from the traditional IRA. So this balance will drop to $22,000, and then it's going to increase by 7%. So the ending value of this account after this year would be $237,061. They're going to be adding this amount to this account, and all of this is assumed at the start of each year, and the Roth is going to have market appreciation. So this, at the end of the first year, would be $297,939. And then as inflation increases, their withdrawals will also increase. So in the second year, they're going to take out $41,200. And the standard deduction, which is going to be the amount that they convert to the Roth, that's going to increase as well from $27,700 to $28,531. So each year, they're basically just going to repeat the process, spending this amount, converting this amount. So let's keep going with this all the way until age 60. So at the start of age 60, you're going to have a joint account with $273,000 in it. You'll have done your final Roth conversion, so you'll have nothing in your traditional IRA, and you will have over $1 million in your Roth IRA. Your expenses will continue to increase with inflation, as will the standard deduction. You will now not have any RMD whatsoever, and everything will be in a Roth IRA account, so you can continue to take money from your joint account until that is fully exhausted. Then everything you have left would be in the Roth IRA, which would of course be taken out tax-free. To achieve this strategy, you need to set up a taxable account, and you need to invest regularly into that account in addition to a traditional IRA. And most importantly, you need to take no action in your joint account. You need to have minimal capital gains as much as possible so you can defer them until the point whenever you can get them and take them out tax-free. One of the best ways to do that is my favorite type of investing, and that is coffee can investing. It involves basically buying stocks or ETFs or any other financial asset and doing nothing for a very long period of time. I have several experiments that I am doing that kind of accidentally became coffee can portfolios. So if you want to follow along with that, I post over on Patreon. I just posted an update of the performance of all of those portfolios. Going back over 4 years now is when I started that portfolio. It's a real-time experiment. It's a lot of fun. So if you're interested, I'll put a link in the description down below. Thanks so much everyone for watching, and I will see you in the next video.